Broadcast is now starting. All attendees are in listen-only mode.
Good afternoon, ladies and gentlemen. Welcome to our broadcast. Christine, I'm not sure what happened, but I'm not hearing your audio. We'd like to welcome you to this, our final webinar of this calendar year. Today we're going to visit the topic of break-even analysis and how to use that within your business. Christine will be monitoring questions, and she will be sending them to me as we go through.
Thanks, Waldo. Sorry about that. I'm back.
Very good.
All right, everybody. So you'll notice that the GoToWebinar control panel is on the right-hand side of your screen, and I want to call your attention to both the questions panel as well as the chat panel. And so if you have any questions or comments, I want you to use these panels to communicate with us during the presentation, and I'm going to be monitoring those for Waldo as we go through. So this webinar is being recorded, and it's going to be available on our YouTube channel. And so you can just go to youtube.com and type in Wyoming Women's Business Center in order to find previous webinars as well as this webinar. Make sure you subscribe and check out everything, and you can also visit us at our website at www.wyomingwomen.org, or also look for us on Facebook. So immediately following this presentation, a survey is going to launch, and we always ask you to complete the survey because it provides us, as well as our funding partners, with valuable information. All participants on the line right now are muted in order to minimize background noise. So once again, if you have any questions or comments during the presentation, I'd encourage you to use the chat box or the questions panel, and we'll be monitoring both of those today. And so as we talk about today's agenda, I'm going to start out just telling you a little bit about the Women's Business Center and and the different networking opportunities that are available within the Wyoming Women's Business Center. And then we're going to jump right into the actual presentation, which is going to be given today by our microloan director, Waldo Smith, who you just met and is on the line as well. So let's start out talking a little bit about WWBC and exactly what our mission is. So what we strive to do is promote economic equality in Wyoming through successful business ownership. And we do that really three different ways. But primarily we're a nonprofit organization, and we assist individuals who want to start or expand a small business. And the requirement is that you're simply in the state of Wyoming. So we service both men and women, even though we're called the Women's Business Center, which is sometimes a little complicated for people, but especially in the microloan program, we do both. As far as client services are considered, we have three. We do business services, which includes business planning and counseling. I like to call it business coaching. And then we also have networking and educational opportunities. This webinar that we're listening to right now is an educational opportunity. And then our program for access to capital, which is our microloan program. So let me tell you a little bit about each one of those. When we talk about business coaching, it's really all about motivating and coaching you to success. And so I always like to say we're the cheerleaders behind your business. Entrepreneurship can often be a lonely place and a little isolating, and we try to make it less for you. Next is networking and educational opportunities. I already pointed to this online webinar as one of those opportunities. We also do monthly roundtables in several markets around the state. And we have our YouTube channel, which has a lot of good content on it. And so we always try to direct people there if they have questions, especially on sales and marketing. Lots of great webinars on that. And then last but not least, our microloan program. Our microloans are loans anywhere between $500 and $50,000 to help fund startup businesses or expansions of existing business. You do need to be a resident of the state of Wyoming. and you have to be registered within the state of Wyoming with the Secretary of State. And if you want more information on that, you can also contact Waldo, and his contact information will be on the slide at the end of this webinar. So without further ado, we're going to launch into this webinar. I'm going to go ahead and turn it over to Waldo, and it looks like he is starting with a poll question. So nice. Go right ahead, Waldo.
Okay, the first question I've got for you is, how often do you currently calculate your break even? Do you do that on a consistent basis? Is it, do you calculate your break evens monthly? Do you do it quarterly? Do you calculate them annually? Or do you not do that because you don't know how to calculate your break evens? All right, we've got everyone has voted. Let's close this and share the results. And it looks like 2/3 of you do it on an annual basis, and 1/3 of you don't do break evens. And that can be understandable if you just don't know how to do those calculations. So that's the reason we're doing this webinar today, to provide you with some simple tools that you can use within your business to help you determine what your break evens are and how to utilize that information. I'm going to start off with a definition. First of all, break-even analysis shows how much revenue or income or sales, whatever term you want to use, how much that will take for you to cover both your fixed and your variable costs, and then what profit it will generate for you. Break-even analysis is an expected component of most business plans. So if you're writing a business plan to submit to a lender or an investment group, you should do this calculation. It's especially important for startup companies to do this, but it's also very important for existing businesses to do these calculations. So further definitions: what is a fixed cost and what is a variable cost? Fixed costs do not change regardless of the amount of sales or quantity of output you have. For example,
hey Waldo, can you close out that poll, and then that way we can see your slide?
I'm sorry.
That's all right. I know those polls can be tricky sometimes. The good news is everybody now knows clearly 67% of you do it annually. All right, so it looks like these are some definitions. Go ahead, Waldo.
Okay, so you can see my slide again now. Fixed costs, again, are costs that you're going to have to pay whether you have any sales or not. Insurance, rent, utilities, telephone, those are fixed costs. And I'm going to give you a better example of that here shortly. Variable costs are costs dependent upon the amount of sales you have. So if you're like in a manufacturing business where you're producing something, labor can be a variable cost in that instance. It's the more product you make, the more labor you're going to have, the more materials you're going to have. It's overhead that changes with the volume or the amount of units you sell in your business. And here's a table. It's not real clear, but it can help you see this on a table and a graph basis. So here's bakers, number of labor, dollar amount of cakes, total revenue, fixed costs, variable costs. You can see the fixed costs are $200 regardless of the number of cakes or bakers that you have. Variable costs, though, increase as the number increases, and it can be seen on this graph. The red line represents fixed costs. The blue line or purple line represents variable costs. Just a good picture of what that looks like. Now, we did a webinar similar to this a year ago, and I used a formula and a spreadsheet that I said I could make available to you. It was a little complicated, but I've come across a different or a simpler method that you can use within your shop using your income statement. And so I wanted to represent this topic again so that you can have those tools available to you. There are three financial reports that you can use within your business. They are the balance sheet, the income statement, and a cash flow statement. The balance sheet basically tells you what you own as far as assets, what you owe as far as liabilities, and the difference between those is the net worth or equity of your business. That's used for specific purposes. A cash flow is generally a statement used to see how cash comes in and out of your business. It is strictly cash. So cash that comes into your bank account from sales of whatever products or services that you have, and cash that you pay out of your business to cover expenses. If you look at a cash flow statement, you'll have a beginning cash balance, income, expenses, month by month or quarter by quarter. At the very end, you'll have cash in the bank at the end of the period. An income statement is different. Income statements look at sales and expenses, but they also take into account some non-cash items like depreciation. So we're going to take a look at that in more detail. The next question I have for you, I've got another poll question that I'd like to throw out there, and that is, how often do you look at your income statement? Do you look at it monthly? Do you look at it quarterly? Do you look at it annually? Or do you leave that up to your accountant and have them give you information or advice based upon what they've produced for you? Okay, looks like about one person. Oh, now we've got everybody voting. So here are the results. And 25% of you look at your income statement quarterly. 75% of you look at your income statements on an annual basis. And that's fine. That's probably pretty typical for most business owners. But we're going to take a look at specifically at an income statement. And I've come up with an example for a company that sells flooring, carpet, tile, and hardwood floors. We're going to look at this as a pretty simple basis. I should throw out a couple of things before we start. I'm using in this example the fact that every piece of flooring, every type of flooring they sell is priced at $10 per square yard. All right, so keep that in the back of your mind. Just this is a simple exercise, simple example. Let me pull up that income statement. And this is where December 20th, they're not going to do any more business for this year. So they've closed out their books. 2018 is all done. And we can look at their figures. Their sales for the year was $1,077,000. Now this is a cash basis balance income statement. I say it's cash basis because we don't have beginning inventory, ending inventory, and adjustments for it. This is strictly income that they've brought in, costs that they've paid out for cost of goods, and then we've got some advertising, bad debt, depreciation, insurance, interest, etc. We've got their expenses. The first thing we have to do is take a look at this balance or this income statement and determine what expenses are variable costs and what expenses are fixed costs. So we said that cost of inventory is a variable cost. The more you sell, the more inventory you have to have. So I'm going to put a V in here for variable. Advertising, usually you have your advertising budget set. You've got a program set up. Regardless of what amount you sell, you're still going to be advertising. So that's a fixed cost. Bad debt is generally considered to be variable cost because the more you sell on credit, the more credit you offer, the more chance you are going to have bad debt. So I'm going to put that as variable. Depreciation is going to be a fixed cost because regardless of how much you sell, you're still going to calculate the depreciation on your equipment, your vehicles, your building, whatever. Did I close out my poll again? All right, so if we go down through the rest of these, insurance is going to be a fixed cost, we said. Interest is going to be a fixed cost because you've got the debt there. You have to pay the debt regardless of whether you make sales or not. Legal and professional is fixed. Office expense is fixed. Payroll taxes are fixed. In this instance, rent is fixed. Travel is fixed. Utilities are fixed. Vehicle expenses are fixed, and wages are fixed. We're not producing anything, we're selling. So I'm counting all wages and cost of wages as a fixed cost in this example for the calculations we're going to do. So everybody clear, we've got two variable costs, the rest of them are all fixed. You might want to write these down. Inventory, cost of inventory was $834,700. Bad debt was $5,000. Those are the two variable costs. So let's go back to our slides here. Give me a second. Okay. So we've made those differentiations. We've split those out. $834,700 was our cost for purchasing inventory, and $5,000 was our bad debt. We add those together and we come up with a total variable cost of $839,700. If we add up all the rest of those expenses, we get fixed cost total of $216,800. And we said our sales was $1,077,000. Okay? So if we take our variable costs and divide that by our gross sales, we come up with a variable cost percentage. $839,700 divided by $1,077,000 in sales equals 78%. If we take the gross sales percentage, which is 100, minus that 78% for variable cost, we come up with a 22% left over, and we call that a contribution margin. Okay? So to determine our break even, we take our fixed costs and we divide them by that contribution margin. In our example, our fixed cost was $216,800. and we divide that by 0.22. You always convert a percentage to a decimal point in a mathematical calculation. So our break even for this business, based upon the 2018 figures, was $985,455. Now we said that our sales was $1,077,000. So we made a profit of approximately $91,545 this year. I didn't put that on the slide, but that's what it would figure out to be. Like I said, always put your contribution margin as a decimal in this calculation. Now, if you wanted to do it in a matter of units instead of dollars, you could do that. This is simple in our case because I said all of our units that we sell cost the same, whether it's tile, whether it's carpet, whether it's flooring, it's all $10 a square yard. So we break even as a unit calculation is your fixed costs divided by your selling price per unit minus your variable costs per unit. All right, so, and I don't want to lose anybody, so I'm going to go through this really slow. $10 a yard is what we sell our carpet or our flooring for. At 78%, which is the variable cost percentage, that's $7.80. Or put this equation in simple terms, it's $2.20 for that 0.22. 22% times $10 a yard. So the fixed cost of $216,800 divided by $2.20 gives us a break even of 95,545 yards. Again, I don't want to lose anybody in this, so what I'm going to ask you is if you are following what I'm doing here in the calculations. If you're not following, raise your hand. Click on the button to raise your hand in the box where the chat and the questions are. All right, I don't see anybody's hands being raised, so I'm assuming everybody's followed this calculation so far. All right, so this tells you what I need to sell dollar-wise to break even for the year, what I needed to sell if you're looking at past. If you think everything's going to be the same next year, you can also project ahead and say, okay, what will I need to sell this coming year if my expenses are the same? You can also use this if you're looking at making changes in your business. So I'm going to open up for my next poll, one more poll question for you. And that question is, what changes do you anticipate in your business for the coming year? Do you anticipate moving to a larger space? Do you anticipate hiring one or more employees? Do you anticipate remodeling expense on your current space? Or is there other items expenses that you anticipate for the coming year that will directly impact your business, that you're going to have to pay cash for or borrow for, whatever? Okay. Looks like a majority of people have voted. Give it another few seconds here. So a majority of you are looking at hiring more employees this coming year. All right. Let's see how we can use this process to determine what our sales are going to need to be in order to cover the expense for these new employees. Let me close that back out, hide that again. Now I should back up a second. In this example, I said that what we sell is all priced the same. You may have different levels. For example, our Works of Wyoming store in downtown Laramie sells things like postcards, drawings, jewelry. They can range anywhere from maybe $10 an item up to $500 an item for a piece of furniture that's handmade or a painting. If you've got a variety like that, the easiest thing to do to utilize this process is to take your total sales divided by the total number of items that you've sold to get an average price per item. And then you can use that for the calculations. That's a real simple method, but it's the best way to do this on an easy basis. Our first example we're going to look at is, what if my rent is going to increase from $1,500 a month to $2,000 a month the coming year? All right, I'm either moving into a bigger space or my landlord just jacked the rent up on me. How do I figure this out? We start out by taking $500 a month increase times the 12 months for the coming year, or it's going to be $6,000 additional fixed cost. If you divide that by the 22%, or the 0.22 that we said was the contribution margin, your sales are going to have to increase in the coming year by $27,273 in order to give you the same amount of profit as you had before. If you want to look at this on a per unit basis, we add the $6,000 to our previous year's fixed cost total, so $222,800. And if we divide that by the $2.20 per yard, or again by the 0.22, 22% of our selling price, then we're going to have to sell 101,273 yards of material for our sporing business, which is an increase of 5,728 yards over last year's sales. Again, I don't want to go too fast on this. I want everybody to get this concept, but I will tell you that if you don't fully understand this, or later on if you start to try to do these calculations and your notes aren't making sense to you, give us a call. We can sit down with you and look at your income statement with you and help you do these calculations. So majority of you said you were looking at hiring people. What is it going to take if we're hiring a new person? And in this example, we're looking at hiring someone and going to pay them $20,000 a year. I'm not taking into account payroll tax. You'd want to add that in, and all the withholding and all of that. But let's just use a simple figure of $20,000. So our fixed cost was $216,800 in the previous income statement. We're going to increase our expenses by $20,000. The labor is a fixed cost in this instance, so we're looking at $236,800 in fixed costs. We divide that again by the $2.20, or the 22% contribution margin, and we're going to have to sell 107,636 yards this coming year to pay for this salesman, which is an increase of 12,091 yards over last year. You can also use this calculation to determine what you have to do to generate a certain amount of profit. Say you want to have $50,000 in profits this coming year. You want to guarantee that you're going to make $50,000 in profit. So we do that. We just figure that in like a fixed cost. We add it to our previous year's fixed cost total, come up with a new total of $266,800. Divide that by the $2.20 per yard. We come up with 121,273 yards we're going to have to sell, which is an increase over last year's sales of $25,728. It is not a direct proportional if you increase your rent, if you increase your wages, salaries, if you want to get a profit. Because of variable costs, it's not a direct correlation. As you increase those expenses, you're going to have an increasing amount of sales to cover them. And this gives you the tools to determine what those are for projecting in the future. Now, one question you may have is, how do I know how to price my product or my services in the first place? Well, I'd like to share this website with you, or this link. This is a Small Business Administration program that can help you through the strategies on how to determine pricing for the product or the service you sell based upon your cost of production or your cost of acquiring, or what your fixed costs and stuff. I would direct you to this site to get help with that. But if you've already determined that and you want to make these calculations, these are simple steps that you can use. So that's kind of a short and sweet presentation. At this point, I would entertain questions specifically to this. And while you are typing those questions into the chat box or the question box, I also want to share this information. We are funded by the U.S. Small Business Administration and the Wyoming Business Council. We also receive funding from the Wyoming Women's Foundation. We want to recognize those partners and thank them for assisting us. And I'll throw up this contact information for everyone within our office so that you can jot that down. But are there any questions at this point?
I'm not seeing any come through quite yet. We'll give people a couple more seconds to type some things in. And it looks like we've got Leslie asking to put up the formula one more time for the contribution margin.
Okay.
So that she can jot that down. So maybe go back in your slides a little bit.
Okay, so we take the, let me back up one slide. Okay, you determine your variable costs, divide that by your gross sales to get your variable cost percentage.
So that's like step one.
That's step one. Step two then is taking your 100%, which is your gross sales, minus the variable cost percent, which in our instance is 78%. So 100 minus point or 1.0 minus 0.78, if you're putting it to decimals, gives you a contribution margin of 0.22.
So it's gross sales percentage minus variable cost percentage equals your contribution margin.
Right. And like I said, the variable cost percentage is variable costs, total variable costs divided by gross sales.
So it's almost, so Waldo, are you saying it's like a 3-step process to get to that number?
Yes, it is a 3-step process. The first step is taking your, let me address Sheila's question. Yes, this webinar is being recorded, and it will be available on our YouTube channel later today. So if you came in late, you can go back through the entire presentation again by going to YouTube and looking up Wyoming Women's Business Center. So the 3 steps we're looking at is we take our income statement, we identify on our expenses which are variable and which are fixed. Variable, again, are things that costs that change based upon the volume of sales. Fixed costs are costs that remain the same regardless if you have sales or not. So you total your variable costs, divide them by your gross income or gross sales, gross revenues, whatever title you want to use, and that gives you your variable cost percentage. That's step 2. And then step 3 is subtracting that variable cost percentage from 100% to get your contribution margin. And then you use your contribution margin to determine what your break even is. You divide that contribution margin into your fixed costs, your total of fixed costs, to get your break even dollar amount of revenues.
So Waldo, when you think about using this calculation, this is potentially a moving target even on a monthly basis to a certain extent, because your variable cost could be changing from month to month. So if you go into the month of January and you've calculated what you believe your break even is, but then you have a new employee that starts on January 10th, well, then your break even just changed, right?
That is correct. And what I would what I would sure recommend doing is, before you make that hire, or before you really commit to making a change that's going to impact your expenses like that, do these calculations first to determine how it's going to impact you and what your sales are going to have to increase to cover that additional expense. I think a lot of people, and you're right, this is a moving target. You can do this annually, you can do it quarterly, you can do it monthly. You may want to do it monthly for the first couple of months until you get comfortable and make sure that things are running smoothly for you. So the big mistake that a lot of businesses make is they commit to additional expenses, whether it be a new rental, adding an employee, or buying a piece of equipment, and they don't realize how it will impact their revenues and their expenses and these margins once they make that commitment. So it's better to do these calculations in advance, to help you prepare for that, to give you a heads up, and then you can focus on generating the sales to cover that going forward.
Yeah, that's really true. Although I know I worked for a company years ago, and the CEO would look at making an investment in the business, and he would often make the comment, we were in membership sales, and he would often make the comment, oh, we can do that. It's just 2 memberships. And I always thought to myself, I don't think it's just 2 memberships. You know, I think it probably is more than that. I don't think that's quite the right way to calculate it.
Right.
But it's certainly an easy way to justify spending, you know, if that's something you want to do. And I always recommend to my clients that they look at their income statement, also known as your profit and loss statement, on a monthly basis, because I want my clients to be really on top of their numbers and understanding if they're profitable each month or if they're underwater. I don't want them to wait an entire quarter or, God forbid, the entire year to figure out that they're losing money. Because, you know, how much money you have in your business checking account is not always a reflection of whether your business is doing well or not. So the health of your business is important to keep track of. And this calculation seems pretty simple to pull off, assuming that your P&L or your income statement is up to date. So it really is something you could do monthly if you're looking at your income statement every month. Absolutely.
Yeah. And I would, if you don't do so, I would highly recommend looking at your income statement on a monthly basis. If you're doing it yourself and you need help, we can help you analyze that. I don't want to be accused of plagiarism, so I will tell you the calculations I'm presenting today are a method that we learned from the Profit Mastery program put on by Steve Lefevre out of the Pacific Northwest. And so we've gone through this training of his. We've got his methods that we're utilizing to offer to clients. And so we can sit down with you and help you do these calculations. But it's important to know where you're coming from. If you are using QuickBooks or an Excel spreadsheet, generate your income statement. And like Christine said, your cash flow can be good. You can have cash in your checking account at the end of the month, but it doesn't always mean that you're profitable when you take into account certain other expenses like depreciation. One of the things I didn't mention early in talking about the difference between a cash flow and an income statement, a cash flow, if you're making payments to the bank on a loan, a cash flow will take into account principal payments as well as interest. An income statement, you do not count that principal, you only count the interest you pay as an expense. So they're 2 different animals, so to speak. And you want to make sure in doing these calculations, you're using your income statement and not a cash flow statement, because they are different.
Absolutely. All right. Well, I think that does it for questions today. So if you want to take us back to our last slide, I will help us close it out. Thanks, everybody, for joining us today. Our next webinar is going to be scheduled for Thursday, January 24th, and it's again from noon to 1 p.m. And we're really going to spend the month of January talking about marketing for your business. And so the title of this next webinar is Developing Content for Your Online Marketing. So look for our emails coming up to register for that. And once again, please take some time. I promise it's only 5 questions. It'll take you less than 30 seconds to complete the survey that's going to launch right after we close out this webinar. We really, truly do read every single survey and your important feedback for our program. So if you have any additional questions, need any further assistance, remember that you can contact us anytime, and our counseling is free. So there's nothing better than free help, and we're happy to assist you. So thanks, everybody, and have a great holiday season.